Hi, my name's Ed Hanna. I'm a tax professional. I've been doing taxes professionally since 1992. I have clients in about 42 states. I do about 1,500 tax returns a year or more, probably 5 to 6 times more returns than the average preparer. So a lot of people came to me and asked me questions about the new Trump tax bill. So I'm going to put together a little video, I figured, so that I wouldn't have to keep repeating myself. I could give them ideas of what's in it, some of the high points and the low points. First off, it doesn't take effect with this tax year. A lot of people are thinking it's going to affect the taxes that they do in 2017. It's not. It's for the 2018 tax year, so it won't affect you until you do taxes in 2019 for the 2018 tax year. The other thing that's prominent that people are trying to take advantage of now is a lot of people are calling me up asking me, should I pay my real estate taxes in advance in order to get extra deductions this year? Well, it's not going to affect your, remember, it's not going to affect your 2017 year, those new tax bills, but the assessors in most areas have ruled, and the IRS has ruled, that if your taxes aren't assessed, paying them early won't get you an extra tax write-off in 2017 when you do your 2016 tax return. So forget about that, most of you. Some places maybe it is assessed by then, then it could benefit you. Now, why would you want to do that? Well, the standard deduction for the 2018 tax year is going to double. So if a lot of people are just barely over the standard deduction for a married couple of, let's say it was in 2016 $6,300 per person, so that would be $12,600 for a married couple. If their itemized deductions were $14,600, then they would get an extra $2,000 of deductible deducted from their taxes, so they would save a little bit on their taxes. So if they could pay that tax bill early, and maybe they add another $3,000 onto it so they could write off $17,000, they could get a little bit better tax return for 2017, and then in 2018 they wouldn't get to write off those real estate taxes because they paid them the year earlier, but they don't think they need them because the standard deduction is going to double. So in other words, if you were getting $6,300 per spouse, now you're going to get $12,600 per spouse for a total of $24,000. And if they weren't going over $24,000, then they're going to take the standard deduction so they can take advantage of those taxes when they're still itemizing. But like I said, the IRS has ruled if those taxes aren't assessed, paying them early won't matter. So if you just send the county an extra $4,000 to go towards your taxes, you do not get to write that off. Even if you paid it in 2017, you still do not get to write it off in 2018 unless those taxes were already assessed. Now, some of the highlights for the average person for the 2018 tax year are doubled standard deduction. So and these change every year. For example, every year they change the deduction, they raise it a little tiny bit. They raise the standard exemption a little tiny bit. They change the tax tables a little bit. So these numbers that I give you may not be exact, but they're going to be pretty close. So like in 2016's taxes, the standard deduction was $6,300 per spouse. So $6,300 if you're single or married filing separately. $12,600 would be if you're a married couple. Well, that's going to change to $12,600 and $25,200 for the 2018 tax year. The 2017 will still be around the same as the 2016. And you get either the standard deduction or the itemized deduction, whichever is higher. Now, that in itself makes a small difference only when it comes to these benefits. For example, somebody who was getting a total of $16,000 in itemized deductions, he was getting an extra $3,400, as you see here, difference, by itemizing. Well, what does that mean on his tax return? If he's in the 10% tax bracket, $3,400 would only save him $340, 10% of it. So it's not a huge difference. But a lot of people think, oh no, I'm going to get an extra $3,400 back. No, you're just going to get the amount of the tax back, which is 10%. So if next year it goes up to $25,200, well, obviously $16,000 in standard deductions isn't going to be higher, so he's going to take the standard deduction. So a lot of people, their taxes are going to become real easy because they're not going to need to itemize anymore. They're just going to take the standard deduction. And then if they got audited, they wouldn't have to prove much because the standard deduction, you don't have to prove. It's just automatic. Whereas if you itemize, they can ask you for your mortgage interest, your real estate taxes, and what did you have in unreimbursed employee business expenses? What did you have in charity? Are those real? Do you have receipts? Now you won't have to worry about it if you go to the standard deduction and it's higher. Some people who already have more than the standard deduction aren't going to benefit from it at all. This is good for the middle class. The upper class, a lot of people there normally had something called AMT, alternate minimum tax. What that meant is that as their deductions kept climbing, the alternate minimum tax, they'd be getting taxed more and it would offset that benefit from the deductions. Well, they're getting rid of the alternate minimum tax, so it's going to help the people that are well-to-do. That's not going to be a really big help for the middle class or the lower class. Some people that are in the upper middle class might benefit from the alternate minimum tax being reversed or rescinded, but other than that, it's not going to be much benefit for the average person. One of the other things is they're going to double the child tax credit. What that means is for each child you have, 16 or under, it doesn't apply to 17-year-olds or above, but for each child you have 16 or under, they're going to move it from $1,000 to $2,000. But that's what's called a non-refundable credit. What that means is you can only get this if you have a tax. So, for example, if somebody has, let's say, $60,000 income, and now they have a $25,200 standard deduction, which means that they now have $34,800 so far as taxable. Then let's say it's a husband, wife, and 2 kids. So 4 exemptions, and let's say the exemptions are around $3,000. I'm just making that up, but then that would be $12,000. What's left is $22,800 is taxable income. Then they calculate the tax off of that. And let's say all of that, I'm just making this up, is in the 10% bracket. That would be $2,280 that they would owe in taxes. Now, if their child tax credit for those 2 kids is $2,000 each, $4,000, they can't get the whole $4,000 because they only have $2,280 in tax. So this will take care of that and leave 0 tax left. Now, for some people, there is a refundable credit that can go on down below their tax. However, that's limited. It isn't $2,000 per kid, it's like $1,400 per kid. So it's not as good of a benefit as they make it sound, because a lot of people, the higher deductions are going to get rid of a lot of their tax. And if they gets rid of a lot of their tax, then they're not going to get the full benefit of the new $2,000 child tax credit. The other thing that's now, it's on the reverse side, is even the tax tables are supposed to change. For example, and I didn't see what the revisions were because they did revise them, but they were thinking of moving the 10% tax bracket to 12%. If they do that, that's an automatic extra 2% you're losing right off the bat. Now, these all sound wonderful, getting more deductions and this extra child tax credit. However, the benefits to the middle class and to the lower class that are going to most benefit them are going to go away. In other words, they're set to sunset. Sunset means that the law is written in such a way that at some time in the future, it reverts back to the way the other law was. Now, of course, the future government could say, let's make it more permanent. Like, for example, Bush created some tax cuts for the rich. Obama said he was going to get rid of them. But when he came into office, he was going to let them sunset. He didn't. He made them permanent. So the same thing could happen to these too. However, there's no guarantee. There's no way we can tell for sure that later on they're going to say, let's keep these. In fact, what they're saying is that when these sunset, as a result of the tax breaks they gave to the rich, which adds up to a lot, when you take away the benefits that were given to the rest of the people, but you still keep leaving the benefits to the rich, we're going to actually have a huge deficit. And they're saying possibly over 10 years, $1.5 trillion is going to be added to the deficit, which that basically means more taxes for everybody. Everybody's going to wind up owing more, or the country's going to wind up owing more interest on that debt that they've created, and we're going to be penalized even more for it in the future. Now, there are some rules that were passed that could be good for the average person, but they weren't really designed to be good for the average person. And that's the S-Corp pass-through. What they wound up doing is they wound up saying that S-Corps would have a lower maximum tax bracket. Instead, right now, S-Corps, for example, might be at 35% for the top bracket. But that depends on how much income you have. A lot of S-Corps aren't even nowhere near that bracket, but they usually only talk about the nominal bracket, the highest bracket. Whereas most people's income is in no percent tax bracket up to their exemptions and deductions. Then some of their income's in the lowest bracket. And then when they get up to a certain level, then some is in the next lowest bracket. And when they get to the next level, then some of it's in the next lowest bracket. So very little of their income actually reaches this bracket. However, they're changing the top bracket down to 21%. So if you have a business that's making good money, then it would be a good thing to have the S-Corp for that reason. But I've already been pushing S-Corps and LLCs that declare themselves as S-Corps anyway, because S-Corps also, by passing through half of their money to themselves, to their personal return as money as a shareholder, then they're already escaping some SE tax. Let me give you a little better explanation of that. Let's say a company is an LLC that's declared as an S-Corp, or a corporation that's declared as an S-Corp. Those companies get to give half of the money that they make to the owner as income for his labor. Some businesses do it as a 1099, some businesses do it as a W-2. And the other half of their money they're allowed to put through on a K-1, which is income for the shares they own. The money for labor has to pay something called SE tax. SE tax, if you get a 1099, is the equivalent of Social Security and Medicare. If you get a W-2, then they already withhold for Social Security and Medicare. Well, this SE tax is about, I think they 15.3% of 92.35%. They got a weird calculation for it of whatever you make. So you have to pay tax on it and this Social Security and Medicare SE tax. But the half that you give to yourself on a K-1 doesn't pay that SE tax. Well, if you figure what is 15.3% of 92.35%, it comes out to around 14.7%. So that means that any money you pass to yourself on a K1, you're saving 14.7% right off the bat. So for that reason, of only on that half of the money. So for that reason alone already, if you are self-employed and you make any amount of money that's decent, you should already be either an LLC that's declared as an S Corp, or you should be a corporation that's declared as an S Corp. The only thing, when I keep saying declared as an S Corp, that just means you filed what's called a 2553 form to the IRS asking them for you to be treated as an S Corp, because that's not a state's rule, that's an IRS rule only. Now, obviously, this huge tax bill that has lots of things in it has way more than what I'm describing to you. What I'm describing to you here is what affects the general person, or the average person that I do taxes for. I don't do taxes for big, huge multinational corporations or for billionaires. I'm doing taxes for average people. One of the other pitfalls that that they're talking about in the future, and some that are affected now, is they're getting rid of the real estate, the mortgage interest deduction for houses at a lower loan amount. They're talking about getting rid of the state income tax deduction and or the general sales tax deduction. They were talking about getting rid of the $250 teacher credit, but they didn't get rid of that. The other ones that don't really affect us, like they're talking about getting rid of the estate tax, stuff like that, that's really only going to affect very wealthy people. A lot of people in the lower class and middle class would like to argue, well, that's a good thing for everybody. Why should my estate, why should I give up half of it? You're not going to anyway, because if the limits are 5.5 million, how many average people have more than 5.5 million for their heirs to inherit? They don't, so it doesn't affect them anyway. But they didn't broadcast that because they want everybody to think that it's going to help everybody, when it's only going to help people with estates more than 5.5 million. They're also really wanting to get rid of the earned income credit, which is going to really mess up the working poor. I don't think they're going to get rid of it easily, because right now a lot of people depend on that. But I don't think the people that are in the position to vote on those laws really care what the average person thinks. They may act like they do, but they really don't. Because the bill is so extensive, though, I'm offering a lot of my clients, if they want to, they can contact me either by email or by text message or by phone or whatever, but I usually prefer email or text. I'll look up stuff and I'll not only tell you what the rule is, but I'll tell you how it may or may not affect you. Because a lot of things that we hear that sound impressive or sound like they affect us really don't. You know, like so many people are worried about stuff that has nothing to do with them. And I like to be able to put their mind at ease. So if anybody wants, my email address is superior411@yahoo.com. And you can text me or call me at 708-655-HELP, which is also 708-655-4357. Other than that, I hope this is helpful information. Have a great day.